Tuesday, May 12th, 2026. While the world was looking at headlines about interest rates and political theater, the heart of the precious metals market just suffered a massive cardiac arrest. We are watching silver climb past $86 as we speak, but the price is merely a symptom. The real story is the silence. Today, for the first time in its 150-year history, the COMEX was forced to halt silver trading twice in a single day. They did not do it to protect you. They did it because the mathematical gravity of a physical supply shortage finally overwhelmed the paper manipulation machine. If you are someone who has spent your life working for a currency that is being systematically devalued, hit the subscribe button and give this video a thumbs up, because what I'm about to show you is the moment the illusion of control finally shattered. Let us talk about what actually happened on the trading floor today, because the numbers alone do not tell the full story. Silver opened calmly at $85.20. The volume was normal. The algorithms were humming along, managing the daily ebb and flow of paper contracts. Then, suddenly, a tidal wave hit. 18,400,000 ounces of paper silver traded in a blinding 15-minute window. The price spiked to $96.80. Boom. The first circuit breaker trips. The exchange claims it is to protect market integrity. But let us be brutally honest here. It was a panic button. 23 minutes later, trading resumes. Did the market cool down? Not even close. The price immediately gapped up to $99.90. Another massive volume surge hit the system. 26,800,000 ounces changed hands in 20 minutes. Silver exploded violently, tearing through resistance levels to hit $107.80. Boom. The second halt, 41 minutes of dead air. This is not normal market volatility. This is the sound of structural failure. We all suffer from a psychological condition known as normalcy bias. It is a deeply ingrained survival mechanism. When a slow-moving disaster is unfolding right in front of our eyes, our brains trick us into believing that things will eventually return to normal simply because they always have. We assume the authorities have a plan. We assume the paper market will fix itself. But history is littered with the corpses of arrogant financial systems that believed they could indefinitely suppress physical reality. Let me take you back to March of 1968. The central banks of the world had formed a powerful syndicate called the London Gold Pool. Their sole mission was to suppress the price of gold and keep it artificially pegged at $35 an ounce to protect the United States dollar. For years, it worked beautifully. The paper illusion held strong. But beneath the surface, physical demand was quietly draining the vaults. The syndicate threw everything they had at the market to stop the price from rising, dumping thousands of tons of sovereign gold to defend the peg. Sound familiar? Finally, on March 14th, 1968, the physical buying pressure became so overwhelming that the Bank of England had to declare an emergency bank holiday and literally lock the doors of the London gold market for 2 weeks. The pool collapsed, the price of gold was freed, and the era of suppression ended in a spectacular, humiliating failure. What we witness today on the COMEX is the modern, digital equivalent of the London gold pool cracking under pressure. The trading algorithms are desperately trying to suppress a physical bank run. Think about the mechanics of the leverage involved here. On the paper exchanges, participants can control $500,000 worth of silver with just $25,000 in margin. That is a 20-to-1 leverage ratio. Under normal circumstances, artificial intelligence and high-frequency trading systems manage this risk perfectly. But when silver moved from $85 to over $107 in a matter of hours, every single leveraged short position faced immediate, catastrophic margin calls. To close those underwater short positions, they had to buy silver. Roughly 370 million ounces of short positions were suddenly desperate for an exit. But to buy that much silver to cover your tracks, the physical metal actually has to exist within the system. The COMEX currently maintains roughly 135 million ounces of registered, deliverable silver. Do the math. The metal simply is not there. They halted the market not to calm your nerves, but to prevent the mathematical impossibility of their own system from becoming visible to the entire world. This brings us exactly to the threshold of what veteran market analyst Michael Oliver calls Phase 3. If you have studied long-term commodity cycles, you understand the progression. Phase 1 is stealth accumulation. The asset trades sideways in a dead range for years, sometimes decades. The mainstream media mocks it. Retail investors lose patience and sell. But underneath the surface, smart, institutional money quietly accumulates positions at bargain prices. Phase 2 is the structural breakout. The asset breaks its long-term resistance. The price begins to rise rationally. Early technical adopters jump in. Silver completed this phase when it finally shattered the massive resistance ceiling it had fought for decades. But Phase 3 is a different beast entirely. Phase 3 is parabolic repricing. It is the moment when decades of suppressed mathematical energy are released all at once. The price stops moving in orderly increments. Volatility expands dramatically, and the asset reprices violently to levels that traditional analysts, trapped in their normalcy bias, will call absolutely absurd. Oliver warned us this exact scenario was coming, and today's double halt is the undeniable starting gun, separating the believers from the mere participants. Let us look at the fundamental anchor of Oliver's framework, the silver to gold ratio. This is not some new, trendy metric. It has been tracked for centuries. Today, even after silver's recent run, the ratio sits at roughly 2%. That means it takes about 50 ounces of silver to buy 1 ounce of gold. But look at historical extremes during major cycle peaks. In 1980, during the Hunt Brothers squeeze, the ratio hit 6.5%. In 2011, it hit 3.1%. Now, project those historical realities forward. If gold continues its current structural climb to, say, $8,000 an ounce over the coming cycle, and the ratio simply reverts to its 2011 peak, the implied price of silver is roughly $250 per ounce. If it expands to the 1980 extreme, the math points to over $500 an ounce. These are not predictions pulled out of thin air. They are mathematical outputs based on half a century of established market behavior, and the physical reality on the ground completely supports the math. According to the latest data, the global silver market is currently running a structural deficit of approximately 67 million ounces. That marks the 6th consecutive year where global demand has absolutely crushed newly mined supply. The cumulative deficit over the past 5 years has exceeded 800 million ounces. That is nearly an entire year of total global mining production gone. Where is that shortfall being covered? By draining the above-ground stockpiles that took generations to accumulate. The demand drivers are entirely structural: photovoltaic solar panel production, electric vehicle manufacturing, military-grade electronics, and advanced semiconductor fabrication. These industries do not lease silver, they consume it. Once silver is embedded into a solar panel or a missile guidance system, it is functionally removed from the global supply chain forever. At our current rate of industrial consumption, higher prices are the only mechanism left on Earth that can force supply and demand back into balance. This is why the leverage thesis in the mining sector is so critical right now. A typical silver mining operation has an all-in sustaining cost of around $20 per ounce. At today's $80 range, they're making a very healthy $60 of profit margin per ounce. But run the math forward into phase 3. If silver hits $300 an ounce, their cost to pull it out of the ground does not change much. That same miner is suddenly earning $280 of margin per ounce. The price of the metal went up roughly 4 times, but the profit margin expanded nearly 5 times. That is the explosive leverage that makes mining equities move faster than the metal itself during a parabolic repricing. However, the narrative shifts from a purely financial calculation to a profound geopolitical earthquake when you look at who is actually demanding the physical metal. The physical silver is migrating east, and the paper games in the West are rapidly losing their authority. Consider the timing. Exactly 48 hours before today's COMEX chaos, the Shanghai-Dubai Gold Exchange announced they are launching a physical silver settlement system. This completely bypasses Western paper markets. Exactly 72 hours ago, Japan reported an 89% premium for physical silver over the paper price. What does that mean in reality? It means massive Japanese industrial users are looking at the COMEX price, recognizing it as a complete fiction, and willingly paying nearly double just to guarantee they actually get the physical metal delivered to their factories. In an era where supply chain security is a matter of national survival, they will not trust their manufacturing output to a paper promise. Furthermore, major silver mining companies are now quietly refusing to honor forward sales contracts at current exchange prices. Why would a producer sell their future labor at an artificially suppressed paper price when alternative networks are offering true physical price discovery? When the COMEX halted trading twice today, they did not halt global price discovery. They only blinded themselves. While the American markets were frozen in panic, silver spiked on the Shanghai and Dubai networks. The trading simply migrated to exchanges where physical settlement is not optional, it is mandatory. The BRICS Plus nations, which now account for roughly 75% of global silver consumption, are actively building alternative price discovery systems that operate in local currencies, completely outside the reach of the United States dollar and Western exchange manipulation. This means the COMEX is slowly being reduced to a regional casino. They can tweak their digital algorithms all they want. They can raise margin requirements overnight to punish speculators and force liquidations. But algorithms cannot print physical silver. When the industrial powerhouses of the East demand physical delivery for their solar fields and defense systems, the paper shorts in the West are trapped in a burning building with no exits. Today, we watch the doors of that building get locked from the outside, but understanding that Phase 3 is happening is only half the battle. The real test is surviving it. When prices go parabolic, greed becomes a toxic contagion. People who bought silver at $30 will refuse to sell at $200 because they are suddenly convinced it is going to $1,000. This is exactly what happened during the 1980 Hunt Brothers squeeze. Silver touched $50 an ounce, and within a few short months, it violently collapsed back below $10. The participants who had a defined exit strategy became incredibly wealthy. The true believers who held on forever became tragic cautionary tales. Phase 3, repricing, does not happen in a stable, peaceful, macroeconomic environment. It happens during extreme systemic stress, and extreme stress creates severe logistical problems. If silver reaches $300 an ounce, will your local dealer even have the cash to buy it back from you? Will governments implement sudden windfall taxes or capital controls in the name of national security? You have to plan your exit before the euphoria takes over. The structural deficit is real. The eastern migration of physical metal is undeniable. And the parabolic Phase 3 move that Michael Oliver warned us about is no longer a theoretical exercise. It is happening right now, confirmed by the chaotic trading halts of a broken system trying to maintain its grip. The smart money is not waiting for a press release to explain this to them, because by the time the establishment admits what is happening, the massive wealth transfer will already be complete. So, how does this actually play out from here? There are only two realistic scenarios left on the table. Scenario 1 is the slow bleed. The exchanges use their remaining digital authority to hike margin requirements to 80 or 90% overnight. They throttle the trading algorithms to artificially freeze the volatility. They might manage to cap the price around $100 for a few more weeks, bleeding out the leveraged paper speculators while the physical metal continues to quietly vanish eastward. Scenario 2 is the cascade failure. The panic we saw today spreads globally. The Asian markets open tonight and simply refuse to accept the artificial paper price. The disconnect becomes so violent that global trading halts trigger one after another like dominoes. The paper market completely breaks, and true physical price discovery takes over, sending the price into the hundreds almost overnight, leaving anyone holding a paper promise completely empty-handed. Either way, the era of Western paper dominance in the silver market is coming to a violent end. History shows us that wealth is never truly destroyed. It is simply transferred from the sleeping masses to the awake and prepared minority. The music has stopped, and the chairs are being removed. If this changed how you see the system, subscribe and leave a comment below. The data is out there. Your job is to read it.
What is the latest figure out of Asia?
We are seeing a major correction across the board.